So we're to the 2 o'clock slot, East Coast time, and the next presenter is Barry Burns. And I see Barry is on the system. Barry, are you there?
I am. Yes, sir. Sir, yes, sir.
Excellent, excellent, excellent. Okay, so what Barry is going to be presenting is how to interpret and trade pure price action.
All righty. Well, thank you for inviting me. It's exciting to be here. I'm honored to be invited to be part of this. So thank you, Brad, and everybody else here who has put this together, and everybody who is here, all of our attendees. Welcome, welcome, welcome. And hope you've been enjoying the presentations so far. So today, we're going to talk about pure price action. So, and actually, I've got a little extra time here. So this normally is a 45-minute presentation. So what I've done is I have added an extra bonus just for all y'all. And this bonus is going to be incorporating volume with price action. So that's going to come toward the end, and it is really powerful. I mean, really powerful. This is a game changer. So that's what I'm going to share with you right now. Is basically how professionals trade and how you can move from loser land to winner world. So you definitely will want to see this. All right. So just a little introduction for myself, and I had I tried to move all of this over to a new slide, and it didn't scale very well, so I kind of squoze it all on here. Squoze, is that a word? I don't know. Anyway, I squeezed it. I think that's the right word. So I am Barry Burns, owner of TopDogTrading.com. I'm also the author of Trend Trading for Dummies, part of the famous Dummy series of books. I'm sure you're familiar with the series by Wiley & Sons Publishers. Very honored to have received many, many Reader's Choice Awards over the years from Technical Analysis of Stocks Commodities magazine. Actually, even more important, like I said, it's a Reader's Choice Award, so it's voted on their subscribers, people like you, real traders. And so that's what I really cherish about that. I've also contributed to other authors' books, work with big companies out there. I'm just going to go through this one real quick. Oh, that worked out really great. You can tell I'm a professional PowerPoint slide maker. You can just tell. The way that I designed this was really artistic. So anyway, I've worked with and continue to work with some of these companies, NinjaTrader, Metastock, TradeStation, eSignal. I've done presentations for the York Exchange, CME Group, yada, yada, yada. So I'm not new to this space, to say the least. In fact, I am 60 years young. Isn't it funny how when we're little, we always want to be older, and when we get older, we want to be younger. So when we're young, a little kid will say, how old are you? And they'll say, well, I'm 7.5. Not 7, but I'm 7.5. They're always pushing it to the opposite end. And then, a common joke when people get older is, well, I'm 60 years young. So I don't know. I don't know where that flips. There's somewhere in the middle there, I guess. But anyway, I'm 60. And my dad started teaching me trading when I was 8. 8 years, I'll say 8 years young, just to throw a wrench in it. Because my dad was a stock trader. And so I grew up in the markets and around the markets. My dad was passionate about the market, so he talked about them all the time, much to my mother's dismay, I might add, and I frankly wasn't that interested either, but he didn't really give me a choice, and so he would once a week sit me down at our dining room table in Detroit, Michigan, and he'd start teaching me about stocks, and later on I actually started to appreciate it and decided to make it my career. So been around the markets for 52 years, and I'm going to give you some of the benefit of 5 decades of trading experience. If you'd like to get more of that beyond the presentation today, I do have a podcast as well. Feel free to go check it out wherever podcasts are available: iTunes, Google Podcasts, Stitcher, Spotify, you know the list. And absolutely free. I don't even accept advertising on it. It's my gift to the trading community. So I invite you to check it out. A lot of great stuff on there. Some of it's just me sharing some great insights that I've learned. Other times I interview guests, and yeah, it's my service to the trading community. So by the way, yeah, this blew my mind. Blew my mind. Thanks to you guys, I can't do this, but it's from your ratings, reviews, stars, all that kind of stuff. You pushed us up to number 10, numero 10, in iTunes, ahead of Jim Cramer's Mad Money, which is just nutso because Jim Cramer was kind of a big deal. So I don't know how that happened, but hey, I'm bragging. Anyway, so I guess you guys might like it. Very important. And I approach this a little differently than most people. So we've got to put these regulatory statements up here. You know, it's required by law, and that's great. And well, it should be. But my take on it is this. So many people see these regulatory statements that we become blind to the statements. And that's a problem because these are really here to help you and help me. Don't think of it just as, you know, legalese. Think of it as part of your education. In fact, the most important part of your presentation. I'm sure you know, in full transparency here, most people lose money trading, and they do. That's absolutely 100% correct. So if that's the case, hey, pay attention that the government has actually, or the regulators, I should say, have gone out and found out why do most people lose money trading, and they've required that we tell you, all y'all, why that is. So I'm not going to read every word here, but, you know, this is just part of it. Feel free to go to TopDogTrading.com, click on our legal disclaimers there, and you can read the full legal disclosure and understand that it's educational. It's there for your protection. This is how you hedge your experience in trading. So even if you've been a trader for a long time, not a bad idea to go back and read it again. In fact, it's a great idea. Okay. So today, price bars and volume. We've updated it a little bit for you today. So let's begin with the beginning because I know we got people at all different levels of education here in trading today. So if you're an experienced trader, hang in there. We're going to cover some basics here for the first 10 minutes or so, and we will get to some more advanced stuff. If you're a total beginner, well, cool. Then this is for you. So what is a bar? Oh, whoops, how did that get in there? That is a bar, but not the kind of bar we're talking about. Okay, if you're if you're health conscious like I am, then that's maybe a better bar to visit. But in trading, that's the kind of bar that we really want to look at. So what do we got? Let me bring up my little laser beam pointer here. So I'm going to use candlesticks today, by the way, and actually the same thing applies to what's called open, high, low, close bar or Western bars. It's called by different names, but we're going to use candlesticks today. I just think they, in my opinion, make things more clear, but either one's fine. So what this bar represents is the range from the low to the high, and then the real body, the green part, is the open here at the bottom, and that's the close. Okay, so pretty darn simple stuff. Like I said, we're starting really with the basics because not everyone knows this stuff. But now, pure price bar, one bar price logic. This is what I want to get into today. I'm not going to get into all the nuances of the 618 candlestick bars created you know, on the beaches of Japan, trading rice in a van down by the river. Well, Chris Farley reference there. So what I'm going to talk about, though, is the logic behind it. I think that's the more important thing than memorizing all of the Japanese candlestick terms. If you understand the logic behind it, you can read anything. And then you know why it is doing what it's doing, you can make some sense out of it. So one bar logic, and then we'll get into two bar logic, and then we'll put multiple bars together and see the logic of that. So one bar logic, there's two elements. Number one is the range of the bar from the low to the high. A wider range bar, more significant. And then from the other part of it, part two, is the range of the bar from the open to the close. Wider range, okay, has significance. So that would be what we would consider a bullish bar, one bar bullish signal, which, by the way, in and of itself doesn't mean a lot. One bar and a $20 bill will get you half a cup of coffee at Starbucks. So this is one thing I see a lot of new traders getting all messed up on, is putting too much significance on a one bar pattern. So that's what that one bar means. That's the logic of the one bar. All right, conversely then, of course, we could see this. So it's just the opposite. Wide range bar from high to low, wide range real body from open to close. Therefore, that would be considered a very bearish bar for just one bar. And by the way, yeah, and by the way, I do want to let everybody know I cannot see your questions. So if you're asking questions, I'm not ignoring you. I can't see them. The window is not operational for me, okay? So don't think I'm being rude. I'm not, and I'm trying to anticipate your questions, actually. So that is one type of one bar logic. Okay, now another type of one bar logic that I really like is where we have, again, a wide range from low to high, but this time narrow range real body, narrow range from open to close. And it comes within an extreme of either the low or the high. You can break this down into halves, quarters, thirds. I would say you'd want this real body. In this case, this is a bearish bar. So you'd want it in the lower third at the very minimum, the lower quarter, maybe even better, of the bar. And now that narrow range real body, in this case it's green, and green means that it closed above the open. And I don't give a mouse's left patootie whether that real body is green or red. You have to understand that the markets are not super persnickety, where they're going to give you, signals to the penny, the pip, to the tick, or, every little pixel on your screen matters. You've got to realize that the markets are kind of a wild beast. They're traded all over the world. People are trading this stuff in all different countries, using different methodologies, different indicators, no indicators, different time frames, and so that creates a bit of noise. And therefore, don't think that every little jot and tittle means stuff on your chart. So the fact that this is a narrow range bar, whether it's a red bar or a green bar, doesn't really make much difference. That's not significant. So it's important to understand what's significant, what isn't. So that is a bearish bar. Now, why is this bearish? Well, because in market profile terms, which I really like market profile theory or market theory, bring this up here. I'll use red. No, let me use blue. Otherwise, it gets a little confusing here. We'll use a neutral color. So what this means, the logic of this, is that the market went all the way up here to this price, tested that price, and it rejected all these prices from there to there. So during this period of time, yep, the market made trades. Trades were made during all these prices, whatever they might be, and I'm intentionally not indicating any particular time frame because it's time frame agnostic, whether it's a 1 minute bar, a daily bar, a tick bar, okay, the concept is the same. So market traded at all these prices, but after all was said and done, during that period, whatever it was, the market rejected these prices. That's called a rejection of value in market profile theory. And so it found value here. After all was said and done during that period of time, let's say it's a daily bar, just as an example, the market, after all was said and done from the morning through lunchtime and through the afternoon, the market settled on that value for the price. Kind of like when you go to, I don't know, let's say a good example would be a new car model comes out, okay, and people and the manufacturer isn't quite sure, since it's a new model, if people are going to like it or not. Well, we the demand, and so they release a small supply because they're testing it, and they'll maybe add to the supply next year if the model proves successful. So the market, meaning human beings, you, me, we look at the car and we decide if we like it or not. If we like it, good, we'll go. I remember I bought a car years ago. It was the first year it came out. It's kind of a hot rod. It was very cool. And the company didn't make very many of them. And I went to buy the car, and the guy says, yeah, we got none. Sorry, can't sell you the car because I don't have any on the lot. He said, it's really in demand. It's very popular. And but I'll take your phone number and I'll give you a call when we get another shipment. He gave me a call. I went, and he said, oh, yeah, we only got 3, and they already sold. I'm like, dude, you just called me, and I came right over. And he says, yeah, I know, but I called like 50 people. He didn't come before the first 3, and the first 3 took them. Like, seriously? So then he got another shipment, like a month later. And so then I went and got it, and one car was left. He says, oh, you made it. We got one car. And I said, okay. So then I try to normally, bargain like you normally think you can for cars. And he's like, oh, no. We don't negotiate on the price. I'm like, really? Am I going to have to pay full retail on this? He says, no, you don't have to pay retail. You're going to have to pay $10,000 over retail. We've marked it up $10,000 above MSRP, manufacturer suggested retail price. I said, what? Are you kidding me? He says, nope. And he says, take it or leave it, because if you walk out here, he says, we've sold every one of these cars for $10,000 over retail price. Why? Supply demand. Markets work the same way. So in this particular case, people were not willing to pay this much for this market, S&P in this case, and they're like, no, not going to pay these prices. I'll pay that. All right, that's what the masses are willing to pay during that time period. By the way, sometimes people ask me, hey, how come if there's a buyer for every, a buyer and a seller for every trade, why does price move? That's why. Sellers aren't going to sell until they get the price that they want. So they will not sell until the buyer comes along to pay more, and vice versa. Okay, and again, just the opposite here. So this would be a bullish bar, by the way. I intentionally used examples with the real bodies, the opposite color of what you might think. So it's red. Sometimes people get all caught up in red, green, red, green. Red is sell, green is buy, right? Nope, not necessarily. Definitely not that simple. What's more important is this long wick down here, or shadow, as is more appropriately called in Japanese candlesticks. And that represents rejection of all these prices. So in this case, again, it's indicating supply demand. Now there is more demand than supply. Down here, people who had it said, I'm not willing to sell it at those low prices. I want a high price. All right, so those are the general concepts. Those are the two, for me, those are the two general concepts that are most important with one-bar logic. Let's go to two-bar logic. So now we have a big red bar, wide range, real body, bearish, right? Then the very next bar, wide range, green. So that's an engulfing type of pattern. A lot of you are probably familiar with that. That's how quickly the market can change sentiment. That's why I said one bar, and what I say, one bar and a $20 bill get you half a cup of coffee at Starbucks. Because this one bar did not change the market sentiment overall. So two-bar logic is that would be now a bullish pattern. This bar invalidated that bar. So two-bar signals are much more, they're more reliable. Again, two bars, just two bars alone don't really make that much difference. And here we get the opposite. So again, bullish bar followed by a bearish bar, engulfing pattern, and that is a two-bar bearish pattern. All right, here's another bearish pattern. now we're bringing back our rejection of value bar. Sometimes these are called pin bars, by the way. And so we've got, now this one, remember our two rules, is it a wide range bar? Not so much, kind of medium. Wide range on the real body, kinda, at least compared to the high and the low. But then we get a long wick. And so as the market came up here, closed here, it did go higher, right? Tested these prices, rejected them, and therefore the indication of the two-bar pattern is bearish. All right, so and then just the opposite again, real quick, would be that rejection of value to the downside, and therefore the two-bar logic would be bullish. Now, what does that indicate? So now, when I talk about the range of the bars and the range of the real bodies, it's all relative to the bars preceding it. So you might ask, well, how do you objectively measure whether it's a wide range bar or not? And that would be a great question for you to ask. And the answer is it's all relative, and it's relative to the previous bars. So here we've got a wide range bar. We'll look at that more in a minute as we get more bars up here. So pretty bullish pattern, and then we get this now narrow range bar and narrow range real body. So bullish or bearish? Bullish. Why bullish? Because this two-bar logic pattern is basically this. We get this bar is a bullish bar. This bar is a neutral bar. So this bar right here is neither bullish nor bearish. So because the bar before it, preceding it, was bullish, sentiment has not changed, and therefore it retains its bullish characteristics. So that's often called, that second bar there is often called a spinning top. Some people get into real nuances with this stuff. Again, to me, that's enough. It's just basically a neutral bar, whether it's a doji, a little spinning top, where it's got a little real body. Again, I'm not going to nitpick on that stuff because I've learned it doesn't really make much difference. Okay, now let's get to the multi-bar patterns and see how this all connects to each other. So go ahead and answer. Now we're going to do some quizzes. You guys thought you were going to come here on a Saturday and just relax and chill on a weekend with your mocha lattes. No, your caviar. No, you're not going to do that. You got to work. This is how you learn. You learn by participating, by engaging. So the market is going to test you every way, right? So I'm going to test you today, and I won't call out any names. No shaming here. Just you and you will know. You and you will know. All right. So don't be ashamed to answer. In fact, this is the way you will learn. So for the bars marked, did they validate or invalidate the price action of the bar that precedes them? So the first one is right there. All right, so that's the pregunta. I encourage you to write it into the question box or the chat box. Did that bar, that little green bar right there, did that bar validate or invalidate the bar, or the price action, I should say, the price action. So when I say price action, I'm not referring to just did this green bar validate or invalidate that bar. I'm talking about did it validate or invalidate that price action, or you can look back as far as you want.
And Barry, it looks like you got a few invalidates so far as answers.
Oh, thank you, Brad. I appreciate that. Okay, so again, we're not going to call out any names, but the correct answer is, here's where I wish I had a drum roll sound effect. The correct answer is neither. Didn't do either. Trick question, sorry.
And you got a few neutrals also. Okay,
you neutral people, you win. This is the one time where being neutral actually is rewarding. So good. Yeah, So it doesn't do either. It was a trick question, and I know that's not very nice of me to start out with a trick question. But
Barry, what if that were bullish engulfing where it was a much larger green candle? So it was maybe, you know, it took out a higher high than the closing of the prior day. Well, not the closing of the prior day, but just it was higher. The green candle, let's say, was higher. Would that, and it was more engulfing. Would that
yeah.
have been bullish?
Yes, if we had an engulf, the green bar there that's marked with the magenta arrow, if that was an engulfing bar, then yes, then I would say that invalidates the price action before it. That would be a weak retrace, and then we would see strength coming in to the upside. So very good, absolutely. So
Okay.
the reason that it is neutral is specifically what Brad is referencing there. It's a narrow range bar, and it's a narrow range real body. So it's just kind of a neutral bar. So it doesn't really validate or invalidate. Now, the reason that I did this, and I did this intentionally to kind of mess you guys up, aren't I nice? I'm as nice as the market is going to be to you. That's why I did it, because this is the stuff that happens, it's going to happen to you in your real trading. You know, in my courses, I think one of the disservices that some courses do and some trading books do is that they only will show you the patterns you should trade, the patterns that work. Now, of course, that's great, right? You do want to see that, absolutely. But the operative word there is only, because it trains your brain that when you go to trade, then you think that's going to happen all the time. That's why they call it a textbook example, right? And that's not the way the wild market works. The market is not so kind and not so neat and not so tidy. So I did this on purpose because the market actually does go up from here. And so the natural human inclination is to say, oh yeah, that would invalidate it. That's a bullish pattern. Why? Because you've got forward-looking bias, because you can see what happens next. Because you can see what happens next, you just say, well, that was a bullish bar. Not every bullish move is preceded by a good buy signal. Might want to write that down. Definitely memorize that. Not every move in the market, whether it's bullish or bearish, is preceded by a good entry signal. In fact, I would venture to say most of them are not. Just because the market made a move does not mean you should have gotten into it, does not mean there was a high probability trade. Most of the time, there isn't. I would also venture to guess that, well, actually, professional traders that I know, and including myself, we probably trade a lot less than you think we do. We probably take fewer trades that we're less active traders than you think we are. The cardinal sin, and I'm guilty of this, is over trading, because we love the trade. We love to trade. We want to trade. It's fun. We like the action, and we want to make money. And that is a one-way ticket to loser land. And I don't mean that in a derogatory manner. I just mean it in a literal manner of losing your money. Why? Because we can't always know what the market's going to do. In fact, we never know. I will say this, we never know, operative word, know what the market's going to do. No one does. Well, God does, but he's not telling me at least. If he tells you, that's great. No one predicts the market with accuracy. So we are purely trading probability scenarios, which means we are not trading certainties. We will have some losses, and those probability scenarios come far and few in between. Because if you think about it, if you ever thought like, oh, the market hates me, the market's against me, you ever feel like the market's your enemy? You are correct. You're literally correct. Your instincts are right on, spot on. And again, there's a logic to that, because what's the market? It's a bunch of people placing trades trying to make money for you. Wait, not for you, for themselves. For themselves. Not you. Nobody in the market who's trading cares about your trade. And there's going to be someone on the other side of your trade. And they're not trying to make money for you. They're not being generous. Where does the money come from the trades? It doesn't come from some neutral pool. It comes from other people who are trying to make money, and they're going to take the money and it shifts from one trading account to another, and they're trying to take it out of your account. So yeah, the market is antagonistic, 100%. So yeah, so I kind of set you up for that, but I wanted to do it for that lesson. So that when you go back and look at historical charts or even do back testing or whatever, just be careful of this. I'm not saying that's not useful. It is useful, but be very careful of this forward-looking bias. We are all subject to it. So that's the lesson that I really wanted to share there. A little extra bonus lesson, but a really important one. So in my courses, I actually show people, I do quizzes like this in my courses, and I actually show them ones that didn't work out. Even some of my valid trade setups that have a high probability, I'll still show them examples that didn't work, even though it was a high probability trade. Why do we do that? Because I want to train their brain cells to get used to the fact that not every even high probability trade will be a winner. To emphasize, place your stops. I put hard stops in. I know exactly where they go. I put in my execution platform. If I'm trading overnight, I hedge my positions against overnight risk with options. I've learned this the hard way by losing 2 truckloads of money. Okay? Pain is a wonderful teacher. Very motivating. All right. Anyway, so those are, hope guys appreciate those lessons. That's very valuable stuff. So now, what about that? Does this red bar validate or invalidate the price action before it? Type your questions in. Maybe, Brad, you can share with me what people are saying there, and we'll see if we've got some winners.
Okay, you got a few invalidates. I think it's an invalidate. I see a shooting star kind of on the left side where that, I mean, the candle wick is higher. I mean, it's not that much. It's not a shooting star, but then I see a larger red candle that's lower and engulfs the green candle.
Yeah, that's exactly right. So we've got, higher high and lower low, and then we've got a engulfing real body. Actually, I guess the whole candle kind of engulfs, hard to tell to the pixel there. But again, we're not going to, measure pixels here. Now, a couple of things. So Brad is right. Of course, that's not surprising. Brad's always right, but he's a good trader, so he knows. So a couple of things. Number one, again, let's go back to our 2 basic rules. It's a wide range bar. Whereas this one over here, to compare to the last example, was a narrow range bar from high to low. It's also a wide range real body, and that's a narrow range real body. So just to compare, all right? So again, what is wide range? What is narrow range relative to the bars before it? So this one's kind of medium, right? That one's wide range. That one's wide range. These are all kind of small, that's kind of medium, right? Okay. And then after it, well, we can see that now, of course, in hindsight. Okay, very good. Awesome. You guys are catching on. I was afraid maybe after that first fake out, you guys wouldn't be willing to participate anymore. But this is what the market will do to you, right? This is what the market will do to you. It will mess you up. It's not going to treat you nicely. It's not going to make everything obvious all the time. So how are we doing on time? Doing pretty good. Okay, then what about this bar? Well, I'll just, you know what? I'm going to go ahead and just answer this one here. So that's a neutral bar, but maybe a little bit bearish. Neutral to doji, open, close at the same level. Again, we could look at this one. Again, why would I not consider that a real bullish bar? Because it's not very wide range. We do have the rejection of value type of pattern down here. We have the rejection of value pattern up here, but the range of the bar is not real wide. So therefore, it just doesn't become that significant because of the noise. The noise, the inherent noise in the market of all the different people and all the different time frames and all the different countries trading all the different methods. It's just, you got to allow for that. All right. So, and then the final one here that we'll look at on this chart, of course, pretty obvious, I think. So, what about this one? Again, wide range from low to high, wide range real body. Now we got some wide range bars coming down, but this one invalidates it, and we go up. Okay, so I just wanted to put a whole bunch of bars on there together so now you start to see how it works in relation to other bars. All right, let's do another quiz. Now this one I'll ask you all to participate in. Now I'm going to make it a little harder for you. You notice I keep increasing the difficulty. So now you don't get the benefit of seeing what happens after. So now you don't get that forward bias opportunity, which is good because the market doesn't give that to us. I mean, I wish my broker would let me make money from trading past historical charts. But my broker is very rude, and he will not let me make money off historical charts. It's just so rude of him. I cannot believe it. I tried to get another broker. He won't let me do it either. So anyway, they all force me to make money on the hard red edge of the screen into the unknown future, which is really annoying. So that's what we got to do. So go ahead and type in, based on this last bar where you see the little red, or no, it's a blue arrow down there, based on the price formation of that bar and anything else there you want to put together on the whole chart, what would you expect to happen next if you were going to take a trade? Or you also, the good thing about trading is you have the option of not taking a trade, right? Go ahead and type in your answers. And while you're doing that, I'll tell you a quick little story. I met a professional poker player in Las Vegas, and I'm not a professional poker player, but I admire the guys who are true professionals. And he just won a lot of money in Vegas playing poker. And there's so many connections between poker and trading. For example, when it comes to the psychology of it, probabilities, and money management and risk management. And I'd highly recommend that you really focus on money management and risk management in your trading. So sometimes I'll ask you the question, what the heck? When I say sometimes I ask, I'll just ask it. Have you spent more time playing around with indicators, or have you spent more time studying money management and risk management? It's almost a rhetorical question because I pretty much know the answer. And you should be spending a lot of time on money management and risk management. Most traders I know spend hardly any, if any, time on it. No, you must master money management and risk management. That's more important than any indicator ever created on this planet we lovingly call Earth. Seriously, my friends, it really, really is. You want to be a professional trader, don't master indicators. Indicators can be fine, not putting them down. Not saying one's bad or good, but I am saying your focus needs to be on money management and risk management. Now, the beauty of this is that in trading, as opposed to playing poker, in poker you got to ante up on every hand, right? So your stash or your whatever, your pile of money, whatever they call it, it goes down a little bit every time that the cards are dealt. But in trading, we don't have to do that. In trading, we have the luxury, and it is a luxury, of just keeping our powder dry and not having to put anything on the trade. So that's an option on this, is you could say, I would buy, I would sell, or I would just do nothing. There's no high probability. So, Brother, tell me, what are people saying?
We got some answers here. We got some neutrals, hold, and some bullish. And then Christopher, you just asked, AJ, you just asked if there will be recordings after these sessions, and yes, all registrants will get an email with the recordings, with a link to the recordings. Awesome. Okay, so we got a mix of bullish and a mix of neutral. Don't do anything.
Okay, so no bearish. Okay, cool. So this is an interesting one. So let me put it all together for you, how I see it. So first of all, we've got a wide range bar. We've got a narrow range real body, but it's in the top third of the range of the bar. We've got a rejection of value wick down here. Where does it reject the value? It rejects it at that previous low. So getting a little messy here. And of course, as you can probably see, we've got a gap. So the way I read this is we get our gap down. The market goes sideways for a little bit, comes down, comes back up, and one bar retests this low. Again, don't worry about that, the low being here. Close enough for government work, close enough for the markets, the financial markets. That is support. It's retesting support. Rejects it. So that rejection of that low combined with the gap, we could say, well, we could have a gap and go, or we could close the window, as the Japanese like to say. And of course, what happens? What is going on? Oh, I see. I got to remove the drawings. Okay. So what happens is the window does close. Gap close after a spike bottom reversal bar. Okay. What happens here? Now I'm going to speed things up a little bit. I won't actually ask you guys to answer the quiz on this one because I've thrown a few extra things in there. So here we've got a nice move up. Okay. Market comes back down off of that. Again, retest this high. Okay, yes, the high is there. But remember, the market found value here at these real bodies. So I would consider that a double top.
Hey,
nice.
Barry?
Yes.
Could we, the one we were just talking about, did you come to a conclusion on that?
Yeah.
What was the answer? I missed it. I'm sorry.
Okay. So that was a bullish bar.
Oh, that was a bullish bar.
Right. Because we
Gotcha.
had a rejection of value on the wick.
Okay. So that was a bullish
low,
bar.
retesting this low with the rejection of value.
Okay.
And a gap above to close.
Okay. Thank you.
Okay. Yep. Absolutely, my friend. Okay. So now this one, we're going to go through this one really quick because I think you guys are probably catching on by now. So double top, wide range bar, open to close, high to low. And so, yeah, that's a bearish bar. What happens next is the market goes down. All right. This one, again, I'm going to answer these. We're not going to do these as open questions. What happens next and why? Well, as you can see, we get on the hard right edge of the screen there a really wide range green bar, opens near the low, closes near the high. What happens next? It goes up. Now, here's where we combine support resistance with it. We started doing that with that gap. So one of the things, this is the same chart, just now showing the future, and so it changed the scale of the chart a little bit. So we had, this is the bar that we were pointing out on the previous slide, wide range bar, open down here, closed up here, but here's the other factor now. We broke through resistance. And so this is why like one bar doesn't mean a whole heck of a lot. Because look at this bar. We've got kind of the same pattern here. Wide range bar, wide range real body. So you might think, oh, that's a bearish bar. Well, it is a bearish bar. You're right. Problem is, one bar, as Brad likes to say, one bar in a $20 bill will get you half a cup of coffee at Starbucks. So the problem is it came right and smacked into support over here. Did not slice through support. This one did. So this is why you must take into consideration as you're looking at these price bars, the entire, what Alan Farley calls the landscape of the chart. Put it all together and not get too enamored by any one bar. Okay, now let's get to the volume part of it. So we use volume in some very specific ways. So obviously we're going to look at large volume versus small volume. Everybody in this parakeet knows about that. Look at the volume histogram at the bottom of your chart, and you see volume goes up, volume goes down. Sometimes you get volume spikes. Okay, that's awesome. On another note, we want enough volume, but not too much volume. If you get too much volume, then it could be exhaustion. So it can go either way. It's a little tricky, right? A little tricky. Again, you interpret it in the landscape of the chart. So if it comes in early in a new trend, it could be a nice beginning of a new uptrend. If it comes in late in an old trend, well, the trend is your friend until the end, and then it's your enemy. If you get a volume spike there, could be an exhaustion pattern. But we don't just want large volume. There's a distinction. And the dollars are in the details. This is the problem with volume and a lot of stuff, just like candlesticks. A lot of traders try to oversimplify things. I think it's really good to keep your trading simple, absolutely. But many traders oversimplify. So, you know, the famous day trader Albert Einstein once said, he wasn't a day trader, at least to my knowledge, but he said, make everything as simple as possible, but no simpler. And that applies to pretty much everything in life, and it definitely applies to trading. So when it comes to volume, there's another distinction, and it's not just the volume bars at the bottom of your chart. There's smart volume, and then there's, well, not smart volume, just retail volume, we'll call it. So what we want, the more important part of it is, I mean, if you're going to look at it, which pretty obvious, probably self-explanatory, but that distinction is very important, because which one do you want to follow? I call this hooking your wagon to the whales. And the whales are the big money, the institutions, placing the big block trades, right? And they are the smart money. They're the professionals, and they're making truckloads of money. They're very educated, they're experienced, and they've got huge accounts. So I'd rather follow the professional money than the retail volume. And both types of volume are on there. But do you know which is which? That's the breakdown that matters. It's not just all the volume, it's which type of volume. How do you find that? All right, let me show you how to hook your wagon to the whales. So how I do it is I bring up a time and sales window. And on this time and sales window, you can usually, this one's TradeStation. You have to ask your charting platform, you know, what type of options they have and so forth. Contact them directly about that, because each one's a little different. But in TradeStation, there's a column here called Type. Now, I don't include bids and asks. You can if you want to. A lot of tape readers will do that, and that can be significant, helpful. But I'm going to just simplify things for you today. So we're going to just look at actual trades. This means trades that are executed. And I think this is very significant, because this means that the money has now left the building, right? Money has left the grubby little mitts of the professional traders. And if there's one thing I know about professional traders, they take their money very seriously. So bids and asks, possibility that there's some gaming of the market there. Even actual executed trades, sometimes they put out what's called feelers. But when it starts to be big orders, not so much. Now they're committed. That's what I want to see. Are they committed? So first thing I do is I personally like to edit my time and sales window so it shows the actual trades, okay, not the bids and the asks. Now, some charting platforms, and again, you'll have to ask yours if they offer this or not, they will actually allow you to plot block trades over here. So what you do here is you can edit the size of the trades that'll show up on your time and sales window. So normally it'll show every trade that comes through the market in real time, and it just plots them here. So there's your time, there's, okay, it's actual trade, the price was executed at, and the size. Notice, now what do we got here? Oh, NQ, okay. So NASDAQ 100 futures. So it's only $5 a contract, but still, I decided in this case to filter it to only show trades that are 20 contracts or more. Now that's per trade. So most amateur traders are not trading 20 lots. They're not trading 20 contracts for every trade they put on. They might be doing 1 or 2, maybe 5, rarely 20. So what am I doing? I'm filtering out most of the retail money, most of the amateur traders, and I don't want to see them. Okay, I want to see just the professional traders. And then I'm saying, okay, what are they doing now? Some trading platforms allow you to actually plot that. Notice down here, it's a little different than a normal volume histogram. Normal volume histogram will have a volume plot under every single bar. This doesn't. This one, in this case, is only showing a volume plots when it's 20 contracts or more. So now I can align it with price action, which is very cool, very significant. You're seeing something new that most people are not seeing. Now, here's another little thing I do. So I was taught how to do this by, some other people. I added this little twist myself, and I find it very valuable. So I decided, maybe I do want to see the retailers, but I want to see them separate. So I created 2 time and sales windows and 2 separate ones. So in one, I actually filtered it so that the trade size is no more than 2 contracts. No more than 2, only 1 and 2. And then on this one, now here I put it at 10, so 10 or more. So now I'm seeing, and you notice the prices are the same, 1205.75, 1205.75, right? In fact, pretty much all of them are the same. We got some 1205.50s in there. So the same price, but the professionals are buying. The amateurs are selling. Huh. Well, how's that? Now what we're doing is we're seeing something that most people don't see, something that's invisible to most traders. Now this is how we break down the distinction between professional traders and amateur traders. We're seeing inside those volume bars, tick by tick, trade by trade. Do you think that might be a little valuable for you? That's what I call, my friends, an invisible edge. Invisible because hardly anybody does this. Very few people do it. Edge because, well, that's why it's an edge. Very few people see this. Everybody in his gerbil sees those price bars. Very few people use this technique. Are there some others who do? Yeah, there's some. Professional traders? Yep. Don't you want to see what the professional traders do? If you want to be a professional trader, yeah, you do. You want to trade like them. Okay, and you can get even more nuanced with this if you want to. I do this personally. It's up to you whether you want to get this detailed or not. I'll leave it up to you, but just to let you know, you can in some. Now this one's NinjaTrader. So I just thought I'd show it on a couple of different charting platforms. So here in NinjaTrader, a couple of other distinctions you can do is you can change the color. This one's lime green if the buy comes in above the ask. So they're getting a little slippage there. They're being a little more aggressive is what that's showing you. And I make mine magenta if they're selling below the bid. Again, being a little more aggressive on the selling side, getting a little slippage, but they're willing to do that because they're being more aggressive. And then I break it down to 2 different columns. So now this one, I've set it so that I'm only showing trades that are 20 contracts or more. But then NinjaTrader also gives you a separate column where you can mark what are called block trades. And then you can set that to whatever parameter you want. I set that at 50. So I'm seeing all the trades 20 or above, 20 contracts or above. But then I'm also highlighting which ones are 50 and above with the word block for block trades. All right, and so what we're seeing is we got some green, we got some red, but the block trades are all red, and even some aggressive block trades that are selling. So pretty powerful stuff. All right, we're seeing inside of volume, that distinction. Here's a really good example of how to use this in practical terms along with price action. So, because price action still matters. We still want to look at the landscape of the chart, right? So landscape of the chart means the whole chart, the whole thing. All right, so a lot of people have problems with breakout trades, false breakouts. And so breakout trading can be very powerful, very good. But the biggest complaint I hear from people who trade breakouts is, hey, I broke out and then it was a false breakout. Dang. All right, so what's one way to help to lower the probability of that happening? Add the block trades onto your chart. So we're in a narrow range here between the value area high and yesterday's low. All day long, blah, 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 nothing going on. Whoops, boom, breakout. Now, is that going to be a false breakout or is it going to follow through? Well, with price action alone, it's really no way to know for sure. But wait a minute, we got a bunch of professional trades coming in on the breakout. That's the smart money. Again, you want to trade with smart money or the unsmart money. I'm going to place my bets on the smart money. Plus, that's big volume, institutional volume. So that alone creates a lot of pressure, right? A lot of power behind that trade, a lot of momentum. And these guys are committed now to the upside, outside of that channel to the upside. So that adds to the probability of this thing continuing to go to the upside and for it not to be a fake out. So really, really powerful tool if you're a breakout trader.
Hey, Barry,
So,
if I can interrupt.
absolutely.
That indicator you were just looking at, what is that indicator?
It's just on TradeStation, I believe it's just called the block trade indicator. Again, some trading platforms have it, some don't. Also, by the way, if your trading platform doesn't have it, I encourage everyone to go check out the discussion boards or the forums of whatever trading platform you have, because in a lot of those trading or in a lot of those discussion boards and forums, users will create indicators and add them there and offer them to other users for free. So if your trading platform doesn't have it native, then go into their discussion boards, type in like block trades or something like that into the search bar and see if anybody has offered it to the community. So yeah, okay. But yeah, block trades is how I've always heard it. It probably goes by other names, but that's the one I'm familiar with. All right, I have 90 seconds to do my big pitch here, but I got nothing for sale. So what I will do is I'll give you one of my courses for free. So yeah. So again, I'm Barry Burns, owner and founder of Top Dog Trading. There's my email address, barry@topdogtrading.com. Feel free, if you have any questions, to send them to me. I love conversing with traders and answering questions. So I'm going to give you one of my trade strategies. Now, I've shared with you some piecemeal stuff here that I hope you find very helpful. This rubber band trade strategy is a complete trading strategy. It's one of my favorite trades. I still trade it every time it sets up to this day. It's I'm going to give you all the rules, all the filters. So this is not just little tips and tricks. This is a full trade strategy. I want you to take it. I want you to make money. Please trade it on a demo account or a simulator first, as you should do with anything new. But it comes with 5 videos. So we're going to send you a video every day. They're short, just like 20-minute videos. At the end of each video is a quiz. You know me now. I love to do little quizzes, but the important thing there is to train your brain. So this is how I educate, by using what I call feedback loops, so that you stay on track and course correct after every lesson. Also, I have a timing indicator that I'll share with you. That's on a follow-up webinar we're going to do next week. If you're interested, it's absolutely free. I'll share the indicator with you, give you an hour of my time, show you how to trade it, and yeah, all for free. So just go to topdogtrading.com/free, and you get everything by just going to that one site and registering there. And I think I'm 30 seconds early. Nope, there it goes, 12 o'clock, at least on my clock. I nailed it to the second. So thank you, Brad. Thanks, everybody. Hope you found the presentation helpful, and it was my honor to be here today.